Welcome to Mastering Candle Range Theory Strategies by cobraclay, me. So, what we will discuss in this long and deeply into the topic video about turtle soup, which says this topic here, how to turtle soup. I will show you everything, every single secret, every single detail about turtle soup and the three range theory or three candles theory to understand charts with simply understanding or by simply applying three candles in the market and trying to read those. Okay, what is contained in this course? Okay, all the knowledge about CRT turtle soup that you will ever need. We will go over everything in detail. This will be a little bit of a longer video. I will cut it down into some shorter pieces because most of you already know all of this stuff. Not everything, which I don't think, because I will include some new knowledge which is straight out of my head, which I learned over years of learning now and studying other traders. Trading knowledge even for pure beginners, so if you're completely new, hello, you just found the only right, correct and easiest way to look at the charts. You will also learn the easiest strategy, okay, so simply where trading is explained with three candles. Nowhere else in market and nowhere else in marketing, the trading industry, you will get trading explained this easily, not even from Romeo. And Romeo's one of the mentors or creators or people who firstly discovered candles or candle range theory, which is in hindsight bullshit if you talk about it from ICT perspectives, but still makes a lot of things easier to explain in the following folds, okay, and pictures and whatever is coming up. Okay, I recommend you to join my free Telegram, and this shit is no promotion, even though you see a lot of my Telegram links everywhere and also in the PDF. In my Telegram you will have a free link to the videos, to the PDFs and everything, okay? It's completely free and I will go into that on the end of the video because everything is discussed in there and pinned. I show you live trades, I show you mindset, stoical quotes, trade breakdowns, some nice information about correlations and important informations which you can apply to avoid losing or to avoid only to focus on the money, so you rather enjoy the process behind it. So I would recommend you to join my Telegram, t.me/notcobraclay. And some three things for and foremost. The black text is just, it's important. Everything I tell you and teach you in these videos, you should write down everything, every single word, even my Telegram, okay? Everything. The blue text is very important, so I would sit down and make myself pause the video, think about it for like 5 to 10 minutes. What does clay mean if there's something blue? And the red text, you write it down and you study it like a motherfucker, because the red text or the red things will be the hardest to understand, but the best to apply in your trading. And once you understand and once it clicks for you, you will be a master of ranges or candle range theory. So the table of contents in this course, and this may seem a lot, which it is, because I literally put every single shitty thing together I found out there for CRT, candle range theory, and also some ICT concepts, as you see the pre-knowledge, open, high, low, close, which we'll get later into it in the video. And I may talk slowly sometimes, I may also talk fast, I may also talk not 100% correct because my English isn't my mother language. So for you to understand everything, what I'm saying is, I want you to watch these videos at least 1 or 2 times or 3 times, even better. Okay, you can maybe, and 90% of you have already read it. The blue boxes here is just some information, just basic knowledge. What is CRT? Candle formations. Pre-knowledge, open, high, low, close, open, low, high, close, the power of 3 in combination with AMD. Accumulation, manipulation, and distribution. Then the same thing again, but only with 3 candle theory, so we will get into CRT into the depth. Time zones in Forex, where to identify monthly, weekly, daily levels and highs and lows, which is also something more ICT specific based. Ranging markets and some nice information for you to understand what to do if market is in a range. And now everything already begins to write down everything that I'm saying, because there's only 2 markets in and out there. It's either ranging or trending. Write that down. Range markets, okay, I've mentioned that, sorry. Turtle soup and its values, determining the higher time frame bias. True structure, because structure explained by all your fucking internet gurus, Twitter gurus, is nonsense. There is shit lacking and some information's missing from true structure, and I will get into true structure later on in the video. Okay, everything here is step by step, so the first thing will be what is CRT. The red circled or squared things are trading models, and for up, I want to tell you, this isn't everything you need to know. You will stick to 1 or 2 of these, and you will only trade 1 or 2 of those. The green things are some nice informations to know and some simple things to keep in the back of your head. Avoid this important information about CRT, EURUSD and DXY dollar index correlations. We will get into one nice example which literally happened a few days ago, from the daily all the way down to the M15 where you enter for a trade. And then I found a nice picture of a simple step-by-step guide. So to start off, what is CRT? CRT is a new strategy which got created by ICT, or better Romeo, and is now refined by me, cobraclay. Everybody else, like Soup Room, is just giving you the information which is already out there. I am creating CRT, or better better words, I wanted to create a new CRT and name it C2RT, because it's cobraclay CRT or clay CRT, because everything I know is combined from everybody out there who knows about CRT. I am the main source of candle range theory on anything. If you don't know anything or everything about CRT, you ask me. Why? Because Romeo won't give you an answer, and ICTs in specific won't even mention your fucking name. CRT is the candle range theory. Every range, or every candle better told, is a range. All candles are ranges, and turtle soup happens at the beginning of a candle. A turtle soup is a manipulation, okay? So either candles get broken out of falsely, or we get broken out and we continue in the trend. The action of deliberate pushing price above an old highs or below an old low with the goal of filling large orders in order to move price. So some words up front. Markets don't move in specific strategies. So if somebody tells you, oh, I trade smart money and I am the bank, they're lying. Market makers or the banks, they don't look at markets and say, oh, there's support and there's resistance. They have their specific price levels, they have their specific areas, and they have their specific positions and orders open, which are formed or which are a form of liquidity. So if you falsely push below an old low or above an old high, you grab a liquidity where you then have enough power and informations, or the banks should, and I don't know if that's true, but that's the only logical explanation behind it, have then enough power to push from one side to another, okay? It's because market acts out of liquidity, stop losses, orders, stop orders, limit orders, whatever is out there. Candle formations, okay? A candle forms with an open, low, high, and then a close. This is a monthly candle, what you see here. This is also a weekly candle, but this is also daily, a 4 hour, a 1 hour, a 4 minute, a 20-second candle, okay? It's not hard to understand. Every candle is built like this picture here. This is literally the meaning of price is fractal. So every candle that you see broken down, and we'll get into it in the depth later, is this shitty picture right here. You have an open, you have a low, a high, and a close. Sometimes you will have consolidation candles, which we'll also get into, where you won't see this nice of a candle formation, but you will always have a wick, which is the low in this picture here. You will always have the body, which is the price action in between, and you will also have a wick on top, okay? And that's it. Homework is to look at the candles and their openings. For you, I want you to now go to the charts, either the monthly, the weekly, and the daily, and I want you to mark out one by one every single candle. I don't give a shit what candle. For instance, go to the daily, mark out Monday to Friday, and then mark out Tuesday opening 0-0, Wednesday opening 0-0, Thursday opening 0-0, and Friday opening 0-0. And I want you to look at the price action, and I want you to see if you can figure out this pattern, which is in this picture here, and apply it to every single candle out there. Because candles are ranges. This is just simply one candle, either if it's the monthly, the weekly, the daily, the 4 hour, the 1 hour, or whatever. And this is the candle in a range. Okay, the candle formation. There are monthly candles viewed in the 4 hour chart. So in between here, you see 2 months of price action in the 4 hour chart. This is EURUSD. And for those who ask, I only trade EURUSD. I don't trade gold, I don't trade Bitcoin, I don't trade GBP, I don't trade AUD, nothing. Every chart that you will see is EURUSD, and otherwise I will tell you that it's DXY or other charts, okay? So the first important information, or very important information, because everything is important with what is coming out of my mouth, is the profiles from higher time frames. So the monthly, in the monthly time frame or in the monthly candle, as you know, this here, this rangey thing that you see here is one monthly candle. The second range thingy you see is another monthly candle. And the profiles to these candles are simply the 4 hour time frame. In the first month, you see a big push higher, okay, grabbing previous monthly high, and then a shit ton of a dump, and then a close, okay? On the second month, you see an open, a small retracement lower, not the nicest one, but still this forms your low, okay? And then you push higher, grabbing previous monthly high, PML, and then you decline lower for retracement or pullback or whatever, and then you close. Simple, will open, low, high, close, open, high, low, close. Okay, for the weekly, so let's say this is one weekly candle, what you see here on the right. You simply go down to the 1 hour time frame, okay, and then you have your profiles, and you can already take trades with this knowledge. I will get later on and in the end of this video into a nice example of the daily profile. For the daily, so this could be one day. One candle is a range, every candle is a range. This is gonna be, or this will be, the 15-minute time frame. And for the 4 hour time frame, so if you have 4 hour candles, and you grow down to the lower time frame, you go to the 5 minute, or if you want, you can also hop into the 3 minute time frame. Okay, Step one is to define what you want to trade. Okay, now there's something I want you to write down, think about it, and make deeply and highly focused notes. I want you to define or pick one that you want to trade and you think is nice. I like the daily time frame because it's simple and easy. I also trade the 4-hour time frame. I don't trade the weekly and I don't trade the monthly because I don't care and I'm not a swing trader. You pick one, either the daily range, which is in the 15-minute, the weekly range, which is the 1 hour, the monthly range, which is a 4-hour, or you trade 4-hour candles, intraday price action, which are 5-minute entries, time frames, and lower time frame pictures. Homework for you, which you see on the bottom right. This isn't that relevant for those who want to make it. I suggest it because you will learn a shit ton, because I did it and Romeo never showed you these things that are possible. Go and do that to every single time frame which you just wrote down. I hope you wrote it down, but which you just wrote down. Okay, pre-knowledge. Pre-knowledge, you not need it if you're completely new to trading, because CRT is so fucking simple. And CRT, the history behind it is one dude literally thought about it to teach 4 people this simple concept of candle opens and time cycles. He taught it them, and then they became the turtle traders. These were 4 traders, and that's where turtle soup, the name, comes from. Nobody ever told you that? Guess so. And this is where the name comes from the turtle traders, and they only learned this and that, exactly this, what I will teach you right now in this video. Recommended to watch is ICT's month 5, 7, and 8. I won't go over IPTA and time cycles and Forex timings in that specific realms or in the depth of it, because I don't care, because there's already ICT's videos out there. And for you to understand it, you can also watch his videos. This is why I thought about making this pre-knowledge fold here, or picture here. Romeo's YouTube videos are also a good help. You don't need to buy his course. You don't need to even look at the leaked course material if it would get leaked, because my course is coming faster than his, I think. Because Romeo's YouTube videos are enough information if you're patient and if you have time span to focus on 40-minute videos. Then it's enough information for you to consider yourself to be a successful trader. Because let me tell you something, you don't need knowledge. You need action, and focus on something and only one thing. Open, high, low, close, open, low, high, close, IPTAs and time cycles. You can, and I don't recommend it because it's just a whole different strategy. Watch Trader Daya. Trader Daya explains time cycles. I would watch his podcast where he explains it a little bit, because then you get the feeling and the hang of it, what AMD is, okay, which we will get into in the next file. But AMD is simply accumulation, a manipulation, and a distribution, which occurs in specific timings, because market is built up on timings where banks open and banks have their transactions between another. Stick to ICT and only me. ICT's knowledge may be boring and monotone, but it's very, very good, and ICT is there, and he's the ghost. He's the ghost of the machine, he's the GOAT, and maybe he can't explain very well, and that's why you have me. Because Romeo only talks in questions, and since Romeo is a busy guy and you won't ever get a response from him, I would recommend you stick to me, since you will 99.95% of the times get a quick response with an answer to your problem. Hit me up on Telegram. I don't care if I'm asleep or not, or if I know about the things that you are asking me. Give me 5 minutes or I will ask my personal assistant, and we will both make sure your questions will get answered in no time. Because nobody out there is this transparent, this honest, and this helping to others, or I'm looking forward to help the most amount of people out there by simplifying knowledge which already exists and not selling bullshit courses, okay? Now we get into the nicer things. We will talk about the OHLC, OLHC, which is PO3, which is the power of 3 if you ever heard about it. Okay, if not, that's totally okay. I will explain it in this video over like 20, 50, 60, 100 times. AMD is the same as power of 3. It's just, in other words, power of 3 is 3 candles in specific, and AMD is also 3 candles. 1 candle accumulates, which is just a consolidation, which goes sideways and feels ugly, looks ugly and is ugly to trade. The M stands for manipulation, which is the candle, the second candle, which grabs liquidity and falsely induces above a high or below an old low. Okay, write that down. The D is the distribution, okay, which pushes in the opposing direction where the turtle soup occurred. OHLC, open, high, low, close. OLHC, open, low, highs, close. The OHLC, OLHC is based on power of 3. Everything is the fucking same. You see here 2 candles, and as mentioned earlier on in the video before, in the first files or the first few files, what is CRT? You see every candle is a range. Every candle has its open and every candle has its fixed close. What happens in between is up to the charts, up to the candle, up to the price action, and to your bias, whatever is going on there. The first one is a bullish candle. Okay, if bullish, buy below the open of the higher time frame candle. So if you are considering to be bullish, or if you just grabbed liquidity or previous month low or high, which we also had an example of, watch that again, then you want to buy below the open, because you would have been stupid to buy at the highest point. You don't want to buy Bitcoin at 100K and then it drops down to 50 and then it pushes up higher to 110K. You only make 10K profits. You want to buy at the 50 mark. So once it drops down to 50K, you want to buy there. And that's where I enter, okay? If you're bearish, it's completely the opposite. You simply sell above the open of a higher time frame candle. Okay, so here you see the 3 candle range theory. This is CRT explained for complete beginners, stupid motherfuckers, and that's the easiest way and form of explaining it. The picture on the right with 1, 2, 3, these candles and the numbers and the meanings behind the numbers, you don't need anything more to be a successful trader. We will get into the depth of the 2 pictures on the left here later on, because that's also can be applied in ranging markets, which we will get into later. But here you simply see an open, a low, a high, and a close. Second picture, open, high, low, and a close. If you want to talk in AMD, you see in the first picture all the way on the left, you have a range. Second candle forms a turtle soup. Third candle gives you the distribution, the push to the opposing end of the range. I'm sorry, there's some construction working going on in the back of my house, and shit is just a little bit loud, but I'm not gonna consider re-uploading every single video because shit takes time. And on the third picture here, you have candle 1. Every single candle is a range. Mark that, write that down. Every single candle is a range. You have the candle 1, and the second candle, which is also a range, opens, gives you a push higher, and closes below. Okay, wicks above, falsely breaks out or breaks out of the first candle's range, closing still below. And then you enter for a sell or either a buy, firstly to the 50% and then 100% to the opposing end of the range, which we will later on get into the depth of it. The open, high, low, close as a candle, for those who still don't get it, is simply you have 1 candle. And now I want you to be very patient, make screenshots, write everything down that I'm saying, because this and the next file is 100% needed to be successful in trading. You have the first candle is a range. The second candle opening, falsely inducing above the high, the first picture. Closing still below the first candle and then closing off. Okay, same thing for bullish scenarios. You have a nice rangy candle, you open, you want to sell above the open for maybe a small push lower, and then you close above and then you buy. Okay, look at that one specific candle which makes the turtle soup. Candle number 2, how it closes. The open, high, low, close in power 3 and AMD. Everything in market comes back to the power of 3. So you will always, in this picture you see perfectly, and you may never ever need something else than the picture on the right, but you see perfectly on the left and consolidation or the opening of the markets. A nice push below a consolidation, which is the manipulation, and then a push to the opposing end of your consolidation. You can already close your trade once it hits the end of the consolidation or the end of the opening or whatever. That's simple price action. That's market. Okay? And on the right, this picture right now, oh my God, it's picture perfect. On the right, you see simple CRT in action. You always induce above old highs. Okay? You falsely induce above old highs to make a false breakout, and then you give the opposing push to the end of the range. You see also some nice timings, which we will now get in the depth of it. Okay, the time zones for Forex. Okay, so Asia range starts at 8 p.m. and ends at 00 midnight. There's a little emoji there, just in case you think it may not be relevant. It's relevant. That's the only range I consider as relevant. Could be also painted in red. The midnight open, the true day open, is at 00 midnight. London open is from 2 to 5, which is a single model, which we'll get later on in the video into it. New York open is from 8 to 11, and you can expect some nice manipulation. And for those who wrote down what a manipulation is and when a manipulation happens, because the manipulation is the second candle where we want to enter. We have manipulations at around 2 to 3 a.m., 9:30 to 10 a.m., okay, and 1:30 p.m. to 2 p.m. Smart money operates in quarters. The whole year is based in quarters. You have spring, summer, autumn, and winter. A specific monthly candle of the year will form the high. A specific monthly candle of the year will form a low. A specific weekly candle of the month will form the high or will form the low of the month. A specific daily candle, and for those who may already know, from Monday to Wednesday, will form the high or the low of the week, and a specific hourly candle of the day. To master a time-based model, which is considered literally this picture here, because you have here 1, 2, 3, 4, 5, 6, 7 nice possibilities to trade, plus the 4 on the right side, which are marked blue. You pick one, okay? You can also pick 2, but not more than 2. And you stick to that. You master a time-based model by simply just picking 1 or 2 things and understanding every single shit behind it. Because the Asia range model is the same as the 2 to 3 a.m., is the same as the 3 to 4 a.m., and is also the same as the 1 a.m. model, but every single thing has its specific things to look into, its specific things that you need to understand about, and some nice knowledge which we'll get later on into the videos, because everything is the same just based on the timings, but nobody tells you that because nobody ever figured that out. Only ICT and me right now. So the time zones for Forex for the daily. Okay, so as you see, this is one daily candle. I also made some nice wicks inside of this. No problem, we will also hop over the weekly and the monthly for those who are asking right now. Okay, in the daily candle, we have 4 nice opportunities for a trade in one day. And that's more than enough to make you profitable. Since you should be asleep at 5 p.m. and 9 p.m., I only focus on 1 a.m. and the 9 a.m. You can also trade at 5 a.m., but we will get into that later because it's a little bit off topic and you need to look into some more specific detailed things because you can also trade 15 minutes, 30 minutes, 90-minute cycles, but that's intermediate to advanced. And there are 10 high probability trades per week. There are 5 days a week, 2 trades, 1 and 9, okay? Once every 1 a.m. candle and once every 9 a.m. candle. And for those who are currently asking, but what is 159? 159, for those who've never seen it, all the numbers 159, 369 is just the New York timings, the opens of the 4-hour candles. Okay? So you have one daily candle which is separated into 6 nice 4-hour candles. You trade 4 of them, or better 2. The time zones for the weekly in Forex, and for those who ask what's it in Bitcoin and indices and stocks, if you trade stocks, kill yourself. For futures, indices, whatever, it's I think the same, okay, in weekly, but in 4-hour there's some difference in it's like 1 hour later or sooner, I don't know, but just Google it, okay? You have Google, you have ChatGPT, or else I will link it down in the video later on. There is 2 high probability trades per week, okay? So if you look at this candle, this is 1 weekly candle, also for you marked as a nice chart, as an open, low, high, close, and as 1 single candle. Every single candle is a range, as you see in between here. And the low of the weekly candle will most likely form in the first or in the second week, or in the day, sorry, on this first or second day, and the high will be kept on Thursday or Friday. One at the low of the week and one at the high of the week, so you have 2 nice trade possibilities. And the low and the high, or the high of the week, will form from Monday to Wednesday, mark that, write that down, and the high of the week will be kept on Thursday to Friday. As you see here, you have a nice opening Monday giving you a really ugly push, but don't consider it to be relevant. Monday is your first candle, your range. If you break down this here, you just simply see 5 daily candles, or you see 1 weekly candle. The first Monday, or number 1, is Monday's range. Monday is 1 candle. The first candle is the range. The second candle opens, falsely induces lower and closes higher. What does that mean? It's turtle soup. You can enter for a buy. Thursday is just, or Wednesday and Thursday is just continuation. Thursday and Friday capping off the trade week with the high. And then Friday also consolidating a little bit, because most times Friday is just consolidation and slow movements. But this here is a perfect picture of how one nice week looks like. And this will happen every single week, no matter what, no matter what pair, no matter what fucking crypto coin, whatever, or which indices. For the monthly, it's the fucking same. The weekly will most likely form, or the weekly low or high will most likely form of the week in week 1 or 2. And the close for a low or a high will form at the week 3 or 4. This here is 1 monthly candle sectioned in 4 weeks. Okay. First week forms the low, first to second week, sorry. And then the 4th week forms the high and caps off the day or the month with a nice, whatever, push lower and a closing. So you have a nice open, low, high, close. And for those who are thinking ahead already, and you are like, but how can I trade open, high, low, close? If you open and you push lower, you already have 2 out of the 4 missing components. So you have an O and a low, or L. You have open and low. The only 2 things that can happen right now is either you push lower, which will be in a not very nice market if you don't hit key areas, or if you don't grab previous month lows, or which is a nice form of liquidity, because you need liquidity for positions, orders, or whatever, for a nice form of energy to push in the opposing end of the range. If that doesn't occur, then no trades. But if you already have 2 out of the 4 opponents, then the rest is simple. Once you understand that every single day is a new opportunity, FOMO, so the fear of missing out ceases to exist, because every single day you can trade 6 trades if you're very good. I only trade 2 times, 1 and 9, but that's simply it. Understand this and you will see trading like buses or trains, okay? Or just like bitches. If you miss one, you will wait for the next one, okay? Either you walk, which is fucking hard, so you stay in front of the charts and you wait for a setup, or you walk. This is your edge against uninformed dumb money traders, okay? So you need to be patient. You have patience and the focus on only the timings which I right now told you, okay? So whether it's week 2, London, or Tuesday, you need to be patient. Market consolidates 70% of the time, or even 80%, and only gives you nice entries around 20 to 30% of the time. For ranging markets, as you see, you already have again 3 candles. Everything comes back to fucking 3 candles, the power of 3. A first candle, Asia, or consolidation. A second candle, maybe London, giving you a false breakout, and then an expansion in the opposing end of the range, targeting Asia high, Asia low, whatever the bias is. CRT also works in ranging markets, okay? So you simply wait for week 1, Asia or Monday to close, and week 2, or London or Tuesday, whatever you're looking into, will grab, or will most likely grab, the liquidity of week 1. Okay, on Monday, week 1, Asia, whatever. Then you simply trade to the opposing end of the range. Let's forget about week 3. Try to blend it out. You see Asia and London formed equal highs, or Monday and Tuesday formed equal highs. So for you to not target these equal highs because you know there are a shit ton of positions and orders and stop losses there, you would have been dumb. So you're dumb money trying to buy at these equal highs, okay? So this is simple breakout traders. So breakout traders wait for a breakout of these equal highs, a retouch and a buy, which they would get fucked. Support resistance traders think, oh shit, we broke out. We wait for a retouch. Our support just turned into, our resistance just turned into support, which is complete bullshit. Every fucking pattern trader would think you just grab liquidity. You can maybe hop onto a nice trade or whatever, and that's complete bullshit. CRT shows you the entries before even other people enter, because I entered on London Tuesday or week 2, whatever you want to call it, at the lowest low possible. Okay, now we come to turtle soup and its values. And now I want you to write everything down, which I'm saying, because it's very, very important. We will talk about determining the higher time frame bias, true structure and PD areas, open high low close, open low high close, candle closes, if then principle, and IPDA. And for those who may know, open high low close and open low high close repeats itself every single time. So any given time frame is only bullish until it reaches a higher time frame key level. Any time frame is only bearish until it reaches a higher time frame key level. What do I mean by that? You are only, and I mentioned that early on, you are only bullish, as in this example here, or here, or here. You can only consider the open, low, high, close principle to function if you take out previous week low, previous month low, if you have a key level which got taken out. Okay, what are key levels? Swing lows, swing highs, order blocks. We will get into that later. Price levels, and I want you to write that down. Think about it, okay? Price levels are useless until time is considered, and time is of no use unless price is at a key level. So for everybody thinking about this sentence right now, but Clay, how do I know, okay, I can only focus on time right now because 1 a.m. maybe where Asia closes and then the London banks come in and give the nice push and the nice equity to push in different directions. But how do I know that shit works? Because if there's no price levels or key levels, why should we push in the opposing end? So it doesn't make any sense. It's like riding a bike, okay? Riding a bike without a chain won't get you anywhere. But for a chain and the pedals to work, you still need the frame and everything, every single other thing from the bike, okay? So the key components is the market. The key components is what's happening and everything around it, the structure, the PD areas, the candle closes, if then, IPTA, what's going on. You need to understand everything, but only focus on one thing. Understand what's going on in your life, understand how or why this bike doesn't just fall apart once you sit on it, okay? A bike is held together by many components, but it only works on one specific time. If you put in the action and the focus to fucking hit those pedals and make the chain go. And the chain is something which is only considered to go on specific times because the bike won't just drive by itself. You need to sit down. And in market, some people sit down on specific timings and they make shit happen. Okay, determining higher time frame bias. Here you see the weekly and the monthly, or I think this is the monthly time frame. Determining the higher time frame bias is simple. ICT, structure, whatever, everything that you will learn. You can also determine higher time frame bias by a simple CRT. Okay. So personally, as you see here, you take out the swing low. You form a CRT, I bought here, all the way up there to the next key area, which is a demand area, because you just broke a low and you don't want to break a high because then market structure wouldn't exist. And we will talk about it in the next file. You mitigate internal liquidities, such like fair value gaps, okay, and then you push lower. You see here market just consolidating, being a little bit gay in the moment here, but you mitigate rejection blocks, which are just big wicks, unfilled, still left with orders, pushing into an opposing end or another direction, breaking again a swing low. So what can you expect right now? Push higher into some nice key areas there, maybe a breaker, maybe this whole fair value gaps which you see here, or even the demand areas which are the extremes, and then another break to the swing low or to the sell side. Okay, open and closes are also determining your higher time frame bias, because once you know the opening and the closes are fixed, you will also know if you open and you form a high, the only two main opening or open components is a low and a close. True structure. As I've mentioned, there's only two markets. Not like stock market, but there's two markets. trending and ranging. The difference is simply, for a trend to occur, you need a range. So market is always going from ranging markets to trending markets. And all of you gurus may explain your market structure like the two pictures on the top right, where you have a low, a high, a higher low, a higher high, a higher low, higher high, higher low, like this shitty thing here. But they can't explain why or when to enter on the higher low. Because if you want to buy below the open. The open is maybe fixed and maybe some people get it, okay? But they still can't figure out when to buy at the higher low. So maybe they buy a little bit before and they get stopped out again, and that's where I just bought, and then market moves in their direction. Because they understand simply one thing and one thing only, which is missing, which they don't understand, is lows, if you're bullish, get rejected and highs get broken. If you are bearish, highs get rejected and lows get broken. So as you see on the bottom left here, for bullish markets to occur, you most likely, and now bear with me, you have ranging markets, you grab the liquidity, so a manipulation and then a distribution. For smart people right now, you will also see power of 3 in this picture on the bottom left. You have a small range, a manipulation, and if you don't have a manipulation, then just don't enter. Simple, that's it. So here, the first low gets rejected. After that, there could be a re-entry, but no consolidation, no entry. Next day, or next few hours, or next few weeks, you also get lows, which get rejected, because you're still bullish. And then you can enter there for a buy. Okay, simple as that. Mostly, and this is very important, we will have a small consolidation before rejecting a low or a high. Relevant PD areas are order blocks, rejection blocks, which are RGB, fair value gaps, breaker blocks, highs. For the discount area, you also have the same, just with the lows. So you have order blocks, rejection block, fair value gaps, breaker blocks, and swing lows. Here you see premium and discount working on one candle, or working on an open, low, high, close principle, or working on true market structure, or working on a range. Everything is the same. As you know, candles are ranges. Every single candle is built the same with open, high, low, close. Every single candle has its range, and that's simply it. So you open, you trade below an old low, maybe even into a discount area. You have now two things, open, low. You push even higher now, above the open. You see open, which is a consolidation, the low, which is a manipulation, and the distribution pushing above the open. Nice. You just had power of 3. And then you have consolidation, rejecting a low. You're still in the discount. Okay. Buy below the open, sell above the high. You buy below the open, you reject the low, and you buy until you're into the premium area and you hit a key area. So that would be the first big leg, as you see here. And then the second one is not that relevant because you're already in premium and you don't want to buy in a premium because that's like buying Bitcoin at 100K. It's just stupid. In combination with candle closes, so this here, you can simply predict or understand if markets will move in certain directions or not. Okay, so what do I mean by that? We have 4 scenarios where you either wick above, which is bearish, close above, which is bullish, wick below, which is bullish, or close below, which is bearish. So right now, bear with me, please. This is important, and maybe some of you won't understand it, but some of you may have already heard it from some ICT YouTube gurus. How to determine daily time frame or daily bias with candle closes is complete bullshit, because they can't explain to you why. They simply just say, well, if the last candle closed bullish and with the candle close, you're still bullish. Wow. Well, yes, but why? So for you to understand this here, we will get into it. I will have everything and every uncertain thing or unclear thing in your head right now will be answered later on in the video. But here you see one candle. Candles are ranges. You trade above the first candle, you trade above the first range, whatever you want to call it, and then you push lower, still being or not breaking the high with the candle close of the first candle. You wick above, you falsely induce price higher, but you close still inside of the candle one, which is a range, which means you're bearish. If market gives you the power of closing above, you are most likely going to be bullish despite the circumstances, if you hit key levels or not, or if you just took out Asia high or whatever, or previous day high, then I would or rethink it if the candle couldn't even push lower a little bit. Same goes for bullish scenarios. If you just wick below, you falsely wick below, you falsely induce people to the sell side, and then you buy. But if you close below, most likely you will have lower prices and you will be bearish. There's the if-then principle. For those who may not know, or also ICT explained that, but it's simply order blocks, fair value gaps. If your structure is bearish and you're in a PD area, so for instance, this swing high to the swing low, or you're at the very, very high area in market, and you just formed a fair value gap, which is a PD area, which we know, okay, because we learned it. If you wrote it down, you may already know it, notice it. You see here, the last daily candle was ranging, okay, the Monday was a range. Then, possible high probability, you have a fair value gap, which is in the premium, okay, and you have a range, which is Monday. You push higher into the fair value gap, and Tuesday forms the high of the week. Yes, most of you will now say, but Clay, we closed above. Okay, so picture number 2 on the right side, close above. We closed above the Monday range. Yes, but if you look at 9 a.m. on this day, on Tuesday, the weekly model isn't based on candle closes. Okay, you can still be bearish. As you see, you take out Monday low with Thursday, you close off with the low of the week of Thursday, and I think afterwards market just skyrocketed to the bullish side. Okay, so you would have gotten stopped out, but that's totally okay, because in hindsight everything was 100% perfect that you made. You were in a discounted in a premium area, you hit a PD area, which is internal liquidity, a fair value gap. You also had a Monday range where your liquidity grabbed the whole fucking Monday range, and maybe 9 a.m. gave you a small pullback because you have a nice wick, and Tuesday will not form the high and the low of the week, because shit can't just be bullish, okay? And then you push the opposing end of the range. We will get into that even later, into the depth, so opposing end range, blah, blah, blah. So, IPDA, Interbank Price Delivery Algorithm. For you to understand it, what I want you to do is watch ICT's videos about IPTA from month 5, I think, and 7. Otherwise, just type in ICT IPTA. Okay, he explains it the best. He also has nice pictures about it. You go back 20 candles in the daily, not bars, candles. There's a specific tool in TradingView that you can use. It's data ranges. It's called data ranges. You click on today and you go down or back 20 days, as you see 20D, 40 days and 60 days. Every 20 days there will be a turtle soup. As you see, from 60 to 40 days, the 40-day high turtle souped the 60-day swing high, or 65-day swing high, what you want to call it. 20-day IPTA just turtle souped 60-day and 40-day swing low. Okay? Enough for you to be bullish, or at least to not be bearish. IPTA is very important when determining the directional bias of the market. Okay, this is how price truly moves. So in specific time periods, market will eventually grab liquidity. Trading models, and now I want you to fully focus. Choose 1 to maximum 3. I would only choose 2, okay, of these, and study them. Write everything down, back test those. When does they occur? Why do they occur? When do they not occur? When do they occur but they are not beautiful? And for the key areas, you will write that down right now, are for your entries, order blocks, rejection blocks, fair value gaps, swing highs and lows, IFVGs, which are inverted fair value gaps, and breaker blocks. If you've never heard about these PD areas or key areas, what an order block, a rejection block, a fair value gap is, or an IFVG, Google it. There's so many pictures out there, and even your dumbest guru can explain to you what a fucking rejection block is. The 4-hour model CRT. So this picture may be familiar for you. And to combine all the knowledge which you right now have, or which I taught you over the few hours or minutes right now, you go to the 4-hour time frame and you mark the last candle, which is number 1, as your range. You buy below the open, or you either sell above the high. Target 1 is 50% and target 2 is then 100%. So in this model you perfectly see how markets move, how candles move, that every candle is a range and every candle also has its open, high, low, close, whatever the shit is going on. This picture here, I want you to screenshot it. This is how markets move, this is how markets operate, this is how markets are, you should view markets as, because it's simple as shit. 3 candles, every candle is a range. So firstly you see 4 candles, 4-hour candles, which are these 3 candles. Secondly, it's the candles as ranges. And thirdly, you have the open, high, low, close, open, low, high, close of those candles. And everything is still the same as in the beginning or in the end. You have a range, either Asia, either Monday, either week 1, either whatever the fuck is going on. You have a range. You falsely break below it with candle number 2. And here you also see, if you look at the range models here, so on the second picture in the middle, you have a small consolidation before inducing the low. And right now, this picture is the only picture that you will ever need again in your life. Study that fucking picture no matter what model you trade. It's always the fucking same, since time is fractal and that shit literally never or literally happens from weekly down to the fucking seconds. Okay, so even market maker models is based on this shit. Everything in market is based on this shit. Price action is based on this shit. Supply demand is based on that shit. Breakout trading, everything that is tradable is based on this shit here right now that you see. I marked you the numbers. So first you have a candle which is a range. Most likely it will be the 21 p.m. candle. 9 p.m. candle New York time. You wait for the second candle to open. And yes, the second candle looks very ugly, but I've broken it down once again into the range. How the second candle should look like to be considered a nice entry or a nice tradable candle. You wait for a small consolidation, and the biggest problem of you is you don't wait for a small consolidation. You must wait for a small consolidation above or below the opening for the second candle. So the second candle opens, you have a small consolidation, you wait for the inducement, so a liquidity grab where you see here number 3, okay, and a nice CISD, a change in state delivery, a break of structure, a change of character, a market structure shift, whatever the fuck you want to call it. For those who don't know, now you know, everything is the same. A market structure shift is a shift in the structure, which is simply the same. A change of character is the change of the state of markets, which is just the same. A market structure shift is the same. Break of structure is the break of a structure to another, I don't know, direction. The professional words are CISD, change in state delivery, because market delivers price, and that's simply it. You then wait for an order block, a fair value gap, a breaker block, or a rejection block. You can also wait for inverted fair value gaps, and then you enter. Number 6 is, if you missed out, you enter below or above the open, depending on the bias, from the third candle. Okay, so the first candle is your range, most likely 9 p.m. The second candle is your manipulation candle in the 4-hour time frame, which is 1 a.m. So 1 a.m. does the turtle soup, first trade possibility of the day. Then you wait for a small consolidation, and since 1 a.m. starts off or kind of ends off with Asia, Asia is most likely going to be your consolidation, but we will go over that later. You wait for your small consolidation, a liquidity grab to either one side, and a nice CISD. Then you can enter. If you missed out on that entry because you were too slow or you were asleep or it's too advanced for you, you wait for the 5 a.m. candle to open, okay? Because you now know you just wicked below, which is a false inducement. So you can trade to the opposing end of the range of candle number 1, to the high. You simply wait for candle number 3 to open. You go to the charts, mark 5 a.m. And once you trade below 5 a.m., so one candle dips lower, you press buy with no stop loss, yes, and you target the range high. After you form a swing low or swing high, whatever, you can move your stop loss to that swing low or something which you want to protect. If you even want to protect the whole candle number 2, you can do that, but then your risk to reward is gonna be shit. Now we get into the 4-hour models. As you see in between here, as I've explained right now, the 1 a.m. model, it's the same like Asia model, it's the same like 4 a.m. model, it's the same like 2 to 5 a.m. model. The 1 a.m. model is you mark the 9 p.m. candle and you mark the 1 a.m. candle. You then wait for the 1 a.m. candle to start. Okay, you have a small consolidation. You have a liquidity grab of a swing low in between here on the right picture. And as you also see on the right picture, okay, where the 5-minute time frame is marked, 3/4 of the 9 p.m. candle is just Asia range. So it's most likely just going to be consolidation. For euro pairs, if you trade yen or GBP JPY, it's gonna look a lot different. But if you trade EURUSD or GBP USD, Asia is 90% just consolidation. Then you have a swing high here. You wait for a CISD. A CISD is a change in state delivery with a candle close. Okay, you wait for a candle close. You candle close above the high, which broke the low. Listen to that again. For the 1 a.m. model, you wait for a 9 p.m. candle to end and then draw a range around it. Wait for a purge at the 1 a.m. opening. Drop down to the M5 and wait for a CSD or CISD, market structure shift, BOS, whatever the fuck you want to call it. Okay? Trade then. So you place an entry, or you place, if you have CISD, you just press buy. After that big white candle there, which broke and candle closed at high, you press buy. Okay? The candle that broke the high, you press buy. Okay? So trade to the 50% and then to the opposing end of the range. And yes, you can also target Asia high if it's a relevant point, but your first target is always the range or the opposing end of the range. You put your SL below the swing low or the high, depending on your bias. You take profit 1 is 50% of the range. You can simply use a Fibonacci tool to mark that. You take profit 2 is 100% of the range. There you can see you also have some nice highs or equal highs or triple highs or whatever. And your additional TP3 is Asia high. And sometimes TP2 is already Asia high. The 2 to 5 a.m. model, as you see in between here, you wait for a purge of the CRT, still 9 p.m. candle. You wait for a small consolidation. You wait for a CISD. You enter. First take profit is the order 50%. Second take profit is 100%. And here you see the second take profit, the 100%, was already kind of the opposing end of the range and also Asia low. But there is simply no difference between the 1 a.m. model and the 2 to 5 a.m. model. The only difference is that between 2 and 5 a.m., as you see these green things in the chart here, there's bangs and some more volatility. So sometimes, and now bear with me, sometimes at 2 a.m. there will be a Judah swing. A Judah swing is a big push, which you can see right now in the picture. After the consolidation is 5 candles or 4 candles just bullish. A big push taking out liquidity, but not marking you the direction where market wants to go to. So you take out shit ton of liquidity, also Asia high, also range high. You open, you consolidate, you form a high with the 2 a.m. Judah, and then you break lower with a nice CISD, where you then can target the low. 3 to 4 a.m. model. It's still the fucking same. Just that if 2 a.m. doesn't form a Judah, 3 a.m. will most likely grab a nice liquidity. In this picture here, you wait for a purge of the CRT. As you see here, it was bearish, still. You wait then for a liquidity purge. So you have a small consolidation or even a big one here. You wait for a CISD or CSD, whatever you want to call it. Okay, so the low that grabbed the high here is candle closed. You enter afterwards, or you can enter on the fair value gap, which I did here. If you form one or leave one behind, whatever. Your take profit 1 is 50%, which already got hit. And your take profit 2 is the opposing end of the range, or even of the small consolidation in between here. It's all the same. So 3 to 4 a.m. model, 2 to 5 a.m. model, and the 1 a.m. model is the fucking same. Just that for the 2 a.m. model, you sometimes have a Judas. So the circumstances around a trade are a little bit different. But if time is considered without a key area, we know no trades. But if a key area is considered without time, no trades. For the 9 a.m. model, it's simply the same. Everything is the same here, just different timings. You wait for the 5 a.m. candle to close, and for the 9 a.m. model to open, or 9 a.m. candle to open. The candle opens, and you see there's not even a nice consolidation, but what do you see? You see 1, 2 candles which are just going or staying still, which are still 10 minutes. If you drop down to the 3 minute, this is a consolidation, but you instantly induce the low. So you open and you have you form a low, and then you push higher with a nice inducement, and you candle close the low, the high, which broke the low. Okay, write that down. You have a nice CISD, and you left a nice fair value gap all the way down there. You also left a nice IFVG. You also have order block down there, whatever you want to use, or if you use, I would have entered on this nice IFVG and this FVG. You have your enter or your entry and your entry possibilities or criterias. And then you see market pushing just higher and instantly mitigating TP1 50%. For those, okay, you wait for a 9 a.m. candle to end and then draw a range. 5 a.m. You wait for a purge at the 9 a.m. opening, drop down to the M5 and wait for a CSD, market structure shift, break of structure, whatever you want to call it. Trade to the 50% and then to the opposing end of the range, which will also be some type of liquidity because they're London closed, which is kill zone. SL below the swing low or swing high, which is still the same. Take profit 1 is 50%, take profit 2 is 100%, and the additional take profits is just higher time frame key levels or whatever you want to use. And there's a simple but yet very effective 90-minute model. I want you to back test this, and I want you all right now to go to the 27th of 8th of 2024. Okay, August, 27 August. You go to 9 a.m. and as you see here, 9 to 9:30 is most likely consolidation, as we've learned. Okay, 9:30 to 10 is manipulation in Forex timings, if you've wrote that down. If not, now there's another chance. If you don't write that down, then fuck you, serves you right to not understand what market is doing. 10 to 10:30 is going to be an expansion. In here you already have candle number 2, the manipulation candle closing off with the expansion, but still nice. I took this trade here, and the only difference is you go down to the 1 minute chart for your entry with a CISD. Okay, and right now bear with me. This model doesn't have to occur 100% on 9:30 to 10 a.m. The liquidity grab can also sometimes happen at 9:15, but also at 9:45. Sometimes, if it's very ugly, the liquidity grab may happen at 10:20 or 10 or whatever. But that's just knowledge, and that's just getting better in trading, because you have to understand that nothing always is perfect, pattern perfect. A fucking bike also doesn't work every single time that you want to use it. You have to oil it, you have to get the right circumstances of the weather and everything, because you can't ride when it's snowing outside and it has like 3 meters high snow. It isn't possible to ride there. But maybe 10 minutes later, some people come and remove that snow, and then it's possible for you to ride even in the snow with your bike. But you have to be patient. Okay, so this model here, the 90-minute model, or the 30-minute model better told, because I want you right now to go into the 90-minute time frame and go to the candle 930 in EURUSD. 930, 80% of the time makes a 80% of the time makes a turtle soup. But the timing is always different. Sometimes it's 9, sometimes it's 9:30, sometimes it's even later on. But then I wouldn't consider it a nice trade, because market is just too slow, and it's already later in the day and it's after 9 a.m. and it's getting to be a little bit late, and late night sessions, afternoon. I don't think, and I don't consider that as a nice trading possibility. But still, this year and also this year, okay, these two are exactly the same, only that time and price are a little bit different. Okay, exactly the same. This year is exactly the same, these two. This to this is exactly the same. You can also make 9 a.m. your model, but you can also add this here, and then you have an advanced 9 a.m. model. I don't know, I don't care. I simply understood that everything in market based on these timings or on these time zones here, which I told you right now, we have manipulation zones from 2, 9 and maybe 13:30, okay, to 2 p.m. You have manipulation zones, but the manipulation won't always happen at the right time. Your boss also won't always be happy with you every single day, and that's okay. And for the 5 a.m. model, it's still the same as for the 1 and for the 9 a.m. model, okay? It's always the same. But for the 5 a.m. model, you can additionally wait for a 6 a.m. liquidity grab. So you hop down, and now be patient. You hop down into the 1 hour time frame instead of the 4 hour. You mark the 4 hour, the 5 a.m. candle in the 1 hour time frame. And for the 1 hour time frame, I would suggest you to go to the 2-minute time frame, because the 5-minute won't give you clear swing lows and swing highs. You can also trade the 1 minute, but then it's way too much noise going on. The 2-minute and the 3-minute give you much more clarity about trading this 6 a.m. model, okay, in the 1 hour time frame. So you go and you mark the 5 a.m. candle in the 1 hour time frame. You wait for a purge at 6 a.m. The low, which broke the high in this picture, gets candle closed, a CISD. And then you have a nice fair value gap there, or multiple fair value gaps, even 2, and a nice inverted fair value gap, which has been touched like 3 times here. You could have entered for a re-entry after a re-entry after a re-entry. You drop down to the M3 and M2, you wait for a CISD, you enter there, and the only thing you need to do is protect the high, and then you enter. First take profit is 50%, which gets smashed immediately. Second take profit then is the opposing end of the range, which also gets smashed pip perfectly. Okay, and for me personally, I entered on this trade exactly like this, but I closed 80% of my position on the immediate touch to the 50%, and then I moved my stop loss to break even, and I got stopped out. Instead of being angry, I re-entered because I knew we are bearish. We just hit PD areas. We just took out previous day high, which is, as you see in between here. I just took out a major points of liquidity, and you also form turtle soups in the lower time frames in here, okay? And here you can also see the 6 a.m. took also out the previous 1 a.m. candle on the left side. So it's just all comes down to key levels, okay? How much liquidity you grab in the markets, and then you can I re-enter there on the second leg and also on the third leg. So a nice 3 or 4 trades in one single day. And that's literally how I trade. Okay. Some things that you want to avoid is always wait for the second candle, the CRT, to take out or fill a PD area. If not, then there's no trade. What do I mean by that? As you see this picture here, the first candle takes out a swing low. As you see this picture here, the first leg here takes out a key level or dips into a key level. Okay, so you always want the first rangy candle to do something important, because the second candle, sometimes the second candle does the important shit, but I more enjoy it when the first candle does something important and the second candle just confirms that the important stuff will work out with closing in the perfect way. But sometimes markets won't be in perfect condition because nothing in life is perfect. Okay, not even me, not even Romeo. And if you think Romeo's win rate is 90%, 93%, he's yapping, he's lying to you. He never showed you anything, and his trade breakdown of trade recaps from 1 year, I can give you a trade recap of 2 years where I documented every single video with every single day. I made a video about it, how I took a trade. Okay, and everything is transparent. So I upload every entry, I upload every single trade I take, I journal every single trade I take with my personal assistant and a buddy of mine. And he doesn't even trade CRT. He doesn't understand what I'm doing, but still trades his thing. But we still stay connected, okay? And we still journal every single day. And I know that I'm one of the best because nobody has so much to show or so much knowledge to give to others because they're just yapping. Okay. The second candle has to form a small consolidation above or below the opening and then take it out. If not, then no trade. So I always want to wait for a small consolidation on the candle which does the manipulation, okay, the turtle soup candle. I always wait for a small consolidation, only in circumstances where I know my bias is 101% right. I enter after a nice CSD immediately, okay, just like in this example. Okay, wait. This here, you have a very ugly example. You don't have small consolidation in between here, but the bias was 100% clear. If higher time frame premise, and the premise is things that you think about, is not in alignment with time, then you don't trade. So either if you don't or do not hit a key level or a key area, and the higher time frame view on your, like your view on markets isn't making sense, and timing isn't considered, then just don't take a trade. The market's just ugly. Look at the candle closes of the previous candles. 4 hour candles, as I've explained the candle closes in this video right now in depth, and the correlation with the PD areas, okay? If not, then don't trade. And a 5 a.m. turtle soup, for me personally, is only considered valid if it has a lower time frame 6 a.m. turtle soup in it. Because at this point may seem confusing, but 5 a.m. is kill zone. So kill zone is some time where 90% of the traders a long time ago just went for the lunch break and volatility laid still. And still to this day right now, volatility ceases to drop a little bit between 12 or 11 to 1 p.m. There's a whole model around 11 to 1 p.m., which is just an ICT model, where you also wait for liquidity grabs, CISDs and everything, which Darius explains. I don't recommend watching it because it's just a whole different strategy. If you want to watch it, it's good information, but it's not CRT, so why would it make sense? You already have around 50 fucking models, which I explained right now or whatever. Okay, for me it's only valid because it gives me the additional confirmation of, okay, 6 a.m. right now, which is 12 for my time, gave me the additional turtle soup, and it looks nice, okay, like this here. Otherwise, in between here, there would just be kill zone, and kill zone is most of the times liquidity. Important informations about turtle soup. Turtle soup will always be in alignment with the higher time frame order flow. So if you're bearish, or one of the first pictures where I showed you what are key levels, like highs, lows of a monthly chart, you reject lows or you reject highs and you break lows. You will always be in alignment with higher time frame order flow, okay? Go back to the first picture I showed you where you had the chart of the monthly chart, where you marked out, where I marked out the weekly, the swing highs, swing lows. Okay, very nice example. Turtle soup will always occur at the opening of new candles. Okay, so a turtle soup occurs always on a 4-hour candle in the first 2 hours, on a 1-hour candle in the first 20 minutes. Turtle soup will always be fast to accelerate from your current price levels at the time. As you see in between here, you fastly accelerate already to the 50% level. Will always occur at a specific timing. 159 is the only thing I trade and I only think is considered important, because 1 includes 2 and 5 a.m., 1 includes 3 and 4 a.m., 1 also includes kill zones, 1 includes, 1 a.m. includes Asia model, okay? 5 a.m. includes the 6 a.m. model, 5 a.m. also includes thinking about ICT's concepts with the kill zones in your mind. 9 a.m. includes specific liquidity grabs and specific timings with 90-minute cycles, 30-minute cycles, 15-minute cycles, which I didn't explain because it's just too intermediate, which nobody will understand because I simply don't care about it and I don't trade it. It's way too intermediate. Okay, I will maybe make a second video about it, a single one, which is like 5 to 15 minutes long, but that's simply it. Turtle soup will always be a false breakout of a range. So if you candle close, it's not a false breakout, it's just a candle close and a continuation of the trend. Everything you are looking for is in the open, high, low, close, and the open, low, high, close. If you study the core content, which was marked, I think, in the blue boxes, you will have everything that you need to understand how markets move, how a candle is formed, how candles move, what consolidations give you for informations, what lows and highs which get liquidity grabbed show you, everything. Okay, because the open and the close is fixed, everything in between is up to you. The structure on the lower time frame that you can see on the candle hitting the key level will reveal the intentions of the candle after that one. So simply, if you look at the lower time frames, so 5 minutes, and you form a small consolidation and you induce it just like in this picture here, which candle 2 does, 95% of the times market will give you a turtle soup candle, close off the right away. If not, then just close the trade. So if this candle does a turtle soup, but closes below, you just close the trade. Simple, that's it. Because it's better to close off earlier than just lose it. And even if market still pushes in the opposing end of the range, you stuck to your trading plan, okay? And you have nice stories to tell because you're the only disciplined and only honest guy about your trading, because every other fucking body would have told, oh, well, I caught this buy. I tell you, I closed this position because the market didn't move the way I wanted to move. That's it. As we've learned, 70% of market is consolidation and 30% is execution and expansion. It's a waiting game, okay? There is no secret behind it. There's no secret strategy, there's no holy grail. The holy grail and your click and aha moment will come once you understand that doing the boring things long enough, okay, will give you or grant you great attainment in every realms that you can think of. Because exemplary diligence, so the focus, or like the mind behind something where you want to achieve something so emotionally attached to something that you want to achieve it with unquestionable exemplary diligence, or the absolute focus on only one thing will give you great attainment. Because being patient is always good, because the patient and the silent dudes in a room will most likely fuck you up in a hard situation, because they know what to do, they know how to handle stress and themselves, their emotions. And I recommend you just read stoical things or whatever, or you join my Telegram. And you can also look for inside bar candles. If you don't know what an inside bar candle is, I can show you. An inside bar candle is, here you see EURUSD, and we will also get into the DXY correlations. EURUSD forming a nice candle, okay? And then 3 days just consolidated inside this consolidation candle, which is ugly as shit. But you still grabbed one side of the liquidity, but never the other one. So if you look at DXY right now, DXY, so the US dollar index, where you can simply find it under DXY, grabs the high, which indicates, I don't know, Monday should or Tuesday should grab the low of EURUSD, which it didn't do because it just consolidated. But DXY took the energy to grab the high, which means there's higher prices for EU and bearish prices for DXY. Mark the range on the Euro and DXY. If EURUSD does not do a turtle soup, then look at DXY, okay? Because, attention, and this is very important, a turtle soup on DXY is also a turtle soup on EURUSD. It is just one that you can't see. If you would be able to trade DXY, oh boy, I would only stick to DXY my whole life, because DXY moves the right way. DXY is straight from the bank, straight from everybody who's working with the dollar indexes and like S&P 500, all the companies combined and together with everything and every pair which has US dollar in it. So it is the perfect correlation for your EURUSD or your GBP USD. If you trade GBP USD, you can also use EURUSD and DXY for correlation. And that's why I don't like GBP USD, because you have to look at 3 charts and you have to have your eyes over 3 charts. You have to understand 3 charts. And for Euro, you can only understand EURUSD. And if there's nothing nice in there, you simply wait and go and look at DXY. Don't overcomplicate it and don't overdo it, because DXY isn't a pair. DXY is just here to give you clarification. It's just like you're asking your mother for, Mom, what's for dinner today? She will give you an answer and you will eat it. That's it. But if she tells you spaghetti is for dinner, it doesn't mean you have to cook the spaghetti. You only focus on your things, which is EURUSD, okay? And DXY does the rest of the stuff. DXY is like your mother. If you need something, you go to DXY, but only if you need something. And here you see EURUSD in the daily, which was, I think, a few days ago. You fill a nice key area, a PD area, a fair value gap, an order block, whatever, you push lower. And Monday, right now in this daily candle here, consolidated and gave you this nice range. So Monday was ranging and Tuesday wanted to form a turtle soup, but closed below. I was like, we took out previous week low with this candle. We also mitigated a fucking internal liquidity there, and we took out the external liquidity, okay? For you to understand what internal and external liquidity is, internal liquidity are fair value gaps where you have imbalances, and an imbalance is the imbalance between orders which did not get filled because market just moved so fast that there's no time to mitigate the things with the wicks, because wicks do the damage and the bodies tell the story. So you have internal to external here, and Tuesday closes off wrong. But if you look at DXY, Tuesday nicely turtle soups the high, still in the nice area here, leaving you even with a nice fair value gap, and you can maybe trade to the 50% because you see the 50% is overlapping with the supply area in Euro or demand area in DXY, and the nice fair value gap which just got formed between these 2 days or 3 days from last week, Monday and Tuesday. If you now break it down, because the breakdown is in the M15, okay, now, because the daily, as you know, the daily profile time frame is the M15. You mark the high and the low of Monday. As you see in between here, DXY or EURUSD in this case did not candle close the right way. But if you look at DXY, you have Monday, you induce higher, you come higher than Asia high, okay, Tuesday Asia high, then you form a nice CISD, and there you can also again look on EU, the low which broke the high, or the high which broke the low, sorry, the high which broke the low in EU on New York, Tuesday, New York, the second or third, whatever you want to call it, red box here. You see the high that broke the low gets candle closed, but in DXY, the low that broke the high never broke the high again. So you would have had to look on EU for the confirmation to sell DXY, but the confirmation in DXY with the candle closes to buy in EU, okay? Very, very simple. So you could have bought here in EU and you could have sold in DXY. But since you cannot sell DXY because it's not a pair, the only thing you can buy is EU. And up foremost, there's a nice file which I found from Trading Psycho and Ray. Big shout outs to them. So Ray is the dude that I found it from, and he has it from Trading Psycho 1 on Telegram if you want to use it, on Twitter, sorry. Give them some credits, but yeah, that's it. We have a trade. So a trade idea, if you have a higher time frame PD area, you wait for 4-hour order blocks, breaker blocks, fair value gaps, whatever is your key area, or for M15 order blocks, breaker blocks, and fair value gaps if you intraday trade with the 1 hours. If you don't have PD areas, but you have a CRT forming at daily, such as this example here. Okay, here you have a PD area and a CRT, which is double confirmation, which is you go to the M15 CRT, you see the M15 does a CRT nicely on EU here, sadly not on DXY, but on EU. Or you wait for 159, 159, I don't know why he forgot the 1 here, but still works. Okay, and then you hop down to the M5, M3, or even M1 for certain circumstances, which we discussed in this video. You wait for a CISD and then you simply enter. Okay, enjoy the learning. Don't forget to join the Telegram. It's again here. Free trading knowledge, free trading mindset, free mindset and stoical things. And I'm considering to leak something which is very, very crazy and important, and maybe also get into mentoring. But we will see how the Telegram group develops, and at around 1,000 members, I will definitely blow your brains. But till then, greetings from me, Cobraclay.